the game through real estate. I can never wait, got what it takes, a got this on my plate, and I got a budget, teach you how to save. Listen to this podcast, you'll be amazed. Play this any morning, any night, any day. We're the winning team, we were born to be brave. Yeah, changing the game through real estate. Yeah.
Hey everyone, it's Tyler Wynn with the winning team, and this is the Changing the Game Through Real Estate podcast. One of the main reasons we started this show was wanting to help people by bringing on guests with inspiring stories that can teach us information that we should have been taught in schools.
All right, folks, today we have our guest, Bill Ham. Bill Ham has been doing real estate through multifamily investing for almost 20 years now. He has an extensive bio on what he's accomplished, so I'm going to let him take it away on what he's done.
Yeah, I appreciate it. Thanks, guys. Thanks for having me on. Yeah, I've been in business for a while now, and I started off in 2005 with a duplex. Was a pilot by trade. I closed my very first deal, which was 2 units, and saved up 10 grand. Property was cash flow at about $300 a month, and I turned in my 2-week notice and just went into real estate full time. Back then I was 28 years old, so I don't necessarily recommend everybody quit their job and go into real estate with the duplex. I was 28 at the time, no children, no family, no real debt. So there's that kind of carve out there. But that was how it was for me. And spent about a year studying, reading books, trying to get my education together, and just pull the trigger, close the first deal, and said, hey, I can figure this out, and just went into real estate full time. Been here ever since.
So how did that work? Because I know usually, like, when people go into real estate originally, they use their job as a way to get loans to invest. How do you do it? Like, once I got property, boom, I'm done. How did that go about?
I probably should have done that. I probably should have kept the job because, 28 years old, no job, no money, no credibility, no experience. Yeah, that's like no loan is what that turns into. That turns into no financing is what that is. So. Yeah, I wish someone would have actually said that or asked that question like right before I quit my job. Would have been, you're 20 years late, so I appreciate that. But other than that, the answer, and that's a great question technically, because it was creative financing was the answer. It was either figure out how to get deals funded or go home. And so what I did was I got out there and figured out how to solve people's problems, people that had real estate problems. And I would do things like seller financing, lease options, partners, credit cards. Don't do that one. But I've done it all. I've financed deals with just about everything, every crazy way you can think of. But that's what I had to do to get started and get going when I didn't have any credibility. So hey, if you're like me and you don't have any money or credibility, you can still buy real estate. There are ways of doing it, but you do have to still be valuable. That's the key. You got to be valuable. And I was able to create value even though I didn't have cash. And that's how I got started.
So how did you find out how to do this? Like, did you just research, or did you just kind of
No, it wasn't anything to research at the time. As far as creative financing is concerned, that there really wasn't a topic that anyone talked about. I mean, I didn't invent seller financing. I didn't invent lease options, but there wasn't anything that really anybody talked about. So I was just out getting deals done any way that I could. And I didn't know that seller financing was a thing. I didn't know that lease options were a thing. I was just borrowing properties and fixing them up and getting them fixed and refinancing them. And I was, honestly speaking, I was embarrassed about that. Yeah. I was embarrassed for the first several hundred units of my career that I was actually out getting seller financing and lease options and creative financing, because I thought all the normal real estate investors in the world just wrote checks and bought real estate. Yeah. Isn't that how everybody buys real estate? You just get a loan, you put down some money, you buy some real estate. That's what everybody does. And here I am over here getting seller financing, and I'm doing lease options and all these other ways. And I thought that was like the poor man's way of doing real estate. And I was embarrassed to talk about it, really. Oh, wow. And I happened to be at a boot camp one time, some kind of general seminar. And somebody asked me how many units I had. I think I was up to like 200-300 units at that point. And they were like, oh, how'd you build a portfolio? And I never wanted to talk about it, right? So finally I was like, okay, fine, look, I got seller financing, I did it. And after talking to the person for a minute, I look up and there's like 30 people standing around me and everybody's like taking notes, and they're all like, and that was my aha moment. They're like, oh, okay, wait a minute. You actually want to know how to do seller financing? Like, you want to know how that's done? Like, I had no idea, and I've been out here teaching that ever since. And I've written a book on it, and a lot of material on that. But yeah, it's a great way to get started, and that's how I got started, was using lots of different creative financing techniques.
So you said you wrote a book on it. What was the name of the book?
Yeah, Creative Cash is the name of that book. I have 2 books out on Amazon. That was my first book, Creative Cash.
Oh, okay.
And yeah, it's all about how to use creative financing for real estate. It's technically about, it's a book teaching you how to be creative and how to create value in business without using cash to do it. You know, so if you can figure out somebody has a problem and you can create a solution to their problem, you've created value, and you can exchange that value for what you need, which is an opportunity. And you don't necessarily have to have cash in a bank account to do it. And that's how I built my first 402 unit portfolio, was strictly creative financing. So that's what the book is about. It's about how to create value and then use that value to close deals.
Yeah, I mean, that's a pretty good point. I feel like even that, like adding value to that's like almost like helping people. Like, hey, what do you need? How can I help you? And I feel like that's like one of the misconceptions with business. Business is a lot to do with helping people, like almost serving people. Like, hey, what do you need? And it's like creating like win-win scenarios. So absolutely,
you know, I teach real estate, as I'm teaching Roberto as well, and I teach a lot of business stuff as well. And that's one of the main concepts in business. Is if you think you're going to use other people's money to create wealth strictly for yourself, you won't be in business long. You know, you cannot, if you're going to use other people's money and other people's wealth to create wealth for yourself, you have to create profit and return for them first, and then yourself second. And you will get paid, and you will make money, and you will gain wealth, but you can't think that other people's money is here to serve you first. If so, you're going to make it through about 1 or 2 cycles, and then people are just not even going to pick up the phone when you call anymore. So, you know, it's really about creating value for others.
Yeah, I actually read your second book, Real Estate Raw.
Real Estate Raw. I appreciate it. That just came out. Hey, there it is. Thank you,
yeah.
sir. Appreciate it.
So, and one of the main things you talked about the beginning was like the conveyor belt, about that's almost like the legit way of doing creating financial freedom rather than quitting your job and doing kind of the hard way you did. So can you explain to people that probably haven't read that book, like what that is and everything?
Absolutely. Well, first of all, read the book, but no, just kidding. Yeah, so the conveyor belt theory of real estate is a concept that I created in order to sort of teach people a fundamental concept about how a real estate portfolio is built. And I tried to use very simple terms. And as you can see in the book, I use very 2-dimensional black and white images because it's very easy to remember. And that's why I use very simple graphics for that. But so basically, like, imagine a conveyor belt, just like one we would have in a factory or anywhere else. And in this example, our conveyor belt is going to be 5 years long, right? And we're using the term, we're using 5 years because that's the average hold cycle for a multifamily property. It can be shorter, it can be longer, but, you know, give or take, it's about 5 years. And so the idea is that we have this conveyor belt that's 5 years long, all right? And that's going to represent the whole time of our portfolio. Year number 1, you're going to put the first property on the conveyor belt. That's your first closing, probably going to be a duplex, like, or something small, like it was for me. So year number 1, my first deal is a duplex that goes in the conveyor belt. As it's moving along, that's our cash flow, that's operations. And so then as it comes off the back of the conveyor belt, that's going to be sort of like a liquidity event, sale, or refi. So year number 1, we put our first closing, our first property on the conveyor belt. That's great. It moves along. Year number 2, we put our second property on the conveyor belt. All right. Those two are now moving along, cash flowing, we're operating. Year number 3, we're going to put our third property on the conveyor belt. This time, maybe it's a little bit bigger. Now we've moved up. Maybe we're doing, you know, some small multifamily, getting into some bigger properties. Okay, year number 4, we're putting our next property on the conveyor belt. Now we're into multifamily commercial. We're getting into larger properties. Year number 5, we're putting that last property on that conveyor belt. Now we're fully upgraded. We're doing larger properties. We still own the first one, maybe that house or duplex, you know, and this is now our portfolio on the conveyor belt. Okay, so now we're in year number 5. The first property that was put on the conveyor belt comes off the end. That's a sale, a refinance, some sort of exit strategy. And the idea is that you're putting properties on the conveyor belt. That's a closing. They're moving along. That's operations and cash flow. They come off the conveyor belt, liquidity event, meaning exit strategy. And the idea is that you want to take the capital gains created from the exit, the refi or the sale or whatever it is, roll that money back around to the front of the conveyor belt, add that to the next purchase. It lowers your need for partners. It lowers your need for sponsors, for investors. The more money you have, the more net worth you have, the more liquidity you have, the more other people's money you don't need, right? And so the idea now is that as time goes on, those smaller properties, you're going to keep coming off that conveyor belt, and you're going to keep putting properties on the back. And over time, you'll upgrade and it'll all be larger commercial multifamily properties. The point of this model is to show you roughly how a business works in real estate. And that's kind of it. Show you that we make money from cash flow through operations, but the real money comes in the liquidity event, the exit. Cash flow is great, it is, but the equity is where we actually make real money. And if you'll take that equity and not spend it and reinvest it, that's how you start to create real legacy wealth. And I know that's a concept a lot of people want to talk about, is how do I create something for my family, for future generations? Well, let me tell you, it's not by having a bunch of investors in a deal that all want you to exit in a couple of years. It's like I kind of talk to people, let's say, hey, you want to create legacy wealth. Oh yeah, of course, great. Why don't you go get a property and ask investors if they want to invest in the property? And when they ask when they're going to get their money back, you tell them when your grandkids sell a property. And let's see how many people actually want to come invest in that deal. Yeah, about none, right? I mean, who wants to give you money so that you can make money for your grandkids? That's not how this works. You see what I'm saying? So the idea is to show that the conveyor belt is how we use other people's money for a while, but over time, if you keep running the conveyor belt, you lessen the need for other people's money, increase your own net worth and equity. That's legacy wealth. That's how you ultimately create something to be left to somebody. But if you're always just leveraged and everything's about everybody else's money, you'll be fine, but you won't leave much to someone else. So I kind of created that model to explain to people basics of how to build a real estate business, and that's why I opened up the beginning of that book with that. And in the rest of the book, Real Estate Raw, is to show you how we put those properties on the conveyor belt. Like, okay, now you understand the conveyor belt. Great, fine. Tell me how to get some properties on the conveyor belt. Tell me how to get some cash flow. Well, that's all the rest of the chapters of the book.
What I really like that you said in that book is like, because everyone, I even see Cardone always has his cash flow is king, cash flow is king, cash flow is king. But one thing you mentioned that I feel like no one really talks about is like, no, that's completely wrong. Equity is king. Can you explain kind of what you mean by that?
Yeah, absolutely. We must have cash flow. All right. So I'm not making light of cash flow and I'm not downplaying cash flow. You must have cash flow. You must buy for cash flow. If you don't have cash flow, you're not likely to operate your property. You're not going to have money to fix things, and you're not likely to be able to feed your investors. But you yourself are not going to get rich on cash flow. Nobody's getting rich on cash flow. You're getting rich on the liquidity and on appreciation. And this is where I kind of think this whole argument that people get into about cash flow versus equity is a stupid argument to begin with. It's a moot point. You have to have both. It's not one is better than the other. All right. You have to have both, but the understanding that all the profit comes from cash flow, careful, that's a sales pitch. That's stuff gurus say when they're on stage to get you to run to the back of the room, get your credit card out and spend a whole bunch of money on their program. Careful. That's not how this works, right? So you can have all the cash flow in the world, and if that property goes down in value, good luck on the exit. Yeah. Good luck on your refi. Good luck on the sale. Right? That's silly. And if you sit here and talk only about cash flow, you're going to turn a blind eye to the importance of an exit strategy, right? And if you don't exit that property profitably, the cash flow is irrelevant, right? So we have to have appreciation. We have to have equity. In where does cash flow even come from? Equity. You have no equity, you have no cash flow. So this is just kind of a dumb concept all the way around that people get stuck up in this. Which is better? I buy for appreciation. I buy for cash flow. No, you're all idiots. You got to buy for all of it. All at the same time, you're going to go broke. You're going to go bankrupt, right? So we have to have appreciation, which comes from location. Never heard the adage, cash flow, but I'm sure you've heard location. Yeah, why, right? Appreciation. And appreciation allows you to sell, it allows you to exit, it allows you to refinance. And without that, you are not going to be in this business very long. All you're buying for is for cash flow. You ain't gonna make it. You gotta have that appreciation, the equity. Yeah, cash flow is good, so I'm not making light of that, but it's an overblown concept. It's a concept that's pretty people kind of stick to it when they're newer to business. Let me put it that way. I'm trying not to be rude in my comments, but when you're more and more new to the business,
they need to know.
Yeah.
Yeah. You're more focused on that cash flow. You're thinking about quitting your job, and you're thinking about, just opening the mailbox, and all these rent checks just come spilling out, rent checks.
Yeah, the ideal world.
It's not how it works. It's just not, that's guru nonsense. But it's about buying good real estate with a proper exit strategy, knowing what you're buying, operating, and selling that thing. I absolutely hate the adage, you make money when you buy. One of the dumbest concepts I've ever heard in real estate. And it is so commonly used. Horrible adage, horrible point of view. Terrible.
So that being said, do you know exactly like what you're looking for when you sell? Let's say like when you talked about conveyor belt, you said, okay, well, when I get to this point in time, like 5 years later, this is what I want to way I see the value going. This is where I know, like, you already have that already calculated in before you buy the price.
Yeah, I've always been of the philosophy, set your returns and walk away when you hit them.
Yeah.
Know what your agenda is, know what your exit strategy is, know what your business model is. And when you accomplish it, cash the check and go home. Stop gambling, stop betting, stop pushing it. Stop trying to time the market perfectly. Stop trying to make till all the lights are green before you back out of the driveway. Look, just set your business model. Don't be greedy. When you hit your returns, walk away. That's a win. And if you get several of these wins in a row, you will build a resume and a reputation that people will seek you out for your skill set. You gamble all the time, you're going to win some, then you're going to turn around and lose some, and you're always going to be kind of 50-50. So yeah, I am of the philosophy, we sell with a calculator, not a calendar. I'm not saying, well, we're holding it from here to here, and we're going to hold it for 3 years, and we're going to have it 5 years. I don't care about that. We set our returns. When we hit said return and we said we'd give said investors, then we're out of here, and we'll rinse and repeat and rinse and repeat. Nobody ever went broke cashing checks, right?
Yeah, that's a good point.
Okay, so for people trying to start off this conveyor belt, what exactly should they be doing in regards to finding their deals? What should their steps be, and how do they accomplish those effectively?
Yeah, I mean, step number one, you got to get an education. You don't know what you don't know, right? And then there's the old argument, should I pay for an education? Well, again, I think that's one of those really stupid comments. You are going to pay for your education. Question is, where do you pay for it, and how much do you pay, right? You can pay someone who knows what they're doing and learn in class, or you can learn out on the street. I don't personally care where you learn. I'm just telling you, learning on the street, like I did, is expensive.
Or you can pay and lose money.
And what?
You can pay and try to do it yourself when buying the deals and lose money. So
that's exactly what I did. I bought my first property after reading Rich Dad Poor Dad, thinking I was all cool. Threw 20 grand into a reno that I did not need to do. And that was my first tuition that I paid for when it comes to real estate investing. Right. So from then on.
Exactly. You know what? My very first deal, that duplex, I still own it. It has sat abandoned for probably 5 or 6 years now. Totally. There's a tree growing through the middle of the damn thing. I wrote that thing off ages ago. But hold on. My point of view is, hey, go out and take action. You screw up one, buy two. You screw up two, buy 10. You'll get it right eventually. Yeah, but hold on, guys. That's a tough point of view. Let's just go do business, and we'll just swing a hammer until we figure it out and either survive it or don't survive it. That's running the gauntlet. And yes, you can do that. And that's what you did, or that's what I did, but I don't necessarily recommend that you just run out on the street trying to figure out business. You can, you will. It's going to be expensive and it's going to be painful. But hey, good for you. Go learn on the street, or vet an educator, vet a mentor, find somebody that can teach you how to do the business. Now, be careful with that, because there are a lot of overnight gurus who close half a deal and now they're out with some kind of giant coaching program. So, be very careful about who you give your money to. Pay attention, vet that individual. That would be sort of my first steps in telling what someone should go out and do, is get education. And then, you got to pick a market. That would be your next step. Figure out where you're going to buy real estate from. And then you're going to need to learn deal analysis. You're going to have to learn what is a good deal. And so, you kind of know where you're trying to buy real estate, figure out what you're trying to buy, and then learn how to analyze it. And those would be the basic steps, for getting started.
So what is a good deal to you? What do you see as what's a good deal?
What would your buying criteria be?
What's that?
What would your buying criteria be number wise? as well.
Yeah, property that makes more money than it costs me to own. Seriously, I mean, that's the straight answer. A good deal is one that makes more money than I spend to own it. You know, so really I always answer that question with a question. When somebody says, well, what is a good deal? Well, what is your cost of capital? That's the real answer. You got to figure out, okay, what is your money going to cost you? Well, we know if you go over to a bank, 75, maybe 80% of the money for the deal is going to be the interest rate. Fine, but what about the down payment? Well, that's either your money that you own, and now you need to figure out what kind of return you want to get on your own money, or you're going out and getting money from investors, and you need to know what kind of return they want, right? So we're talking about equity stack is what it is. You've got to kind of pay, you got to figure out what is the cost of your equity stack. So we take a look at the money that comes from the bank these days, 4 or 5%, whatever it is. You look at what the money that needs to go to investors, 6, 7, 8% maybe, you know. And so to me, a deal is anything that overrides that cost and produces more money than that. Then that's a good deal, you know.
Okay, so when it comes to finding deals nowadays, with the amount of money that people are splurging on multifamily real estate, they hear about the returns and they're like, I'm going to go pay this at like a 4.5 cap in a 6 cap market. And we're all loving it, right? So how long are you seeing? I know that you've mentioned to me before the race to 80 concept. Is that still prevalent in today's market, or are we starting to see it become a little bit longer until you find the deal that you're looking for?
Yeah, it might be. What you're talking about, mentioned race to 80. I've kind of got a theory that you will close about 1 in every 80 deals that you analyze. And that number may be a little bit higher today, maybe more like 1 in 100. But the math is still there. There's still deals. But yeah, you've got to get out and sift through a lot of junk to find the diamond there in the rough. But yeah, it's still a process of analyzing deals, and it's tough. Yeah, the deal flow is slow right now, and inventory is slow, but you just got to stay at it and keep looking at deals, you know, just keep grinding.
Are you finding most of those deals that you're analyzing today off market? Do you go that route? Are you working more with your brokers? How are you been doing that?
Yeah, me personally, I don't typically look at deals off market so much, because that constitutes you really trying to go directly to an owner. And I have found that works very well for under 50 units. So if your space is under 50 units, I strongly recommend you try and get a direct contact campaign going, mail, letter, phone call, something where you're reaching out to owners directly. I personally don't buy properties that small anymore, so it's not very viable for me to send We Buy Apartments postcards to the guy who owns 200 units, because nobody's going to sell me 200 units because I sent him a little yellow postcard that said, please sell me your apartment complex. That's not how that works, right? Those properties are largely sold by realtors, you know. And so when you're trying to be in the larger commercial space, you really have to have strong relationships with realtors, and I do in my markets. So that's where I find most of my deals is still through realtors, through relationships with realtors. Ideally, I'm trying to get a look at that property before everybody else sees it, before the realtor puts the listing all the way out on the market. So that's kind of the key, is like build good relationships with your realtors. They usually pick up the phone and give you a quick call when something comes to the door. Maybe they give you an early look before everybody else gets to see it. That's about as good as you can do these days.
If you're willing to tell us, what markets are you looking at?
Oh, that's a secret. No. Southeast. I live in Atlanta, and I look in the southeastern markets in general. But you know, me and about a billion other investors. So, yeah. You know, Southeast, right? I mean, like, who isn't looking in the Southeast at the moment? Especially but yeah, North Carolina, South Carolina, Tennessee, Georgia, Northern Florida. You know, I'm lazy. I don't really want to travel that far, so that's kind of my radius. About an hour plane ride around Atlanta. That's kind of my market.
I got you. Can you kind of take us through like a inside track of like you analyzing a deal, what it looks like, your due diligence phase, kind of how you talked about in the book? Can you just kind of like break that down, like your process of going through everything?
Yeah, I mean, that would be a long answer, but I mean, you know, what I do is all right. I'll give you a general answer to that. I don't like analyzing deals. Number one, I've already mentioned I'm relatively lazy, easily distracted, and I'd rather go do things with my afternoon than analyze deals, especially if this deal sucks, right? So and I'm relatively suspicious and paranoid person. So I come at all deals with the concept, this deal sucks. And all deals are bad deals until I can prove it's a good deal. See, most people come at a deal thinking there's a good deal in here somewhere, and if I just stare at it long enough, it'll become evident. Nope, not me. I think all deals are awful. until I can prove it's a good deal. And I don't want to sit here and analyze bad deals. So I'm trying to get to a no as quickly as possible. So I look through low-hanging fruit metrics to try and hurry up and find out that the deal sucks and discount it. If I can't kill the deal, then I go further and further and further in the analysis. So kind of keeping it light, what I would say is start off with your rent roll. Read the rent roll. Look at the tenant balance column. There should be a tenant balance column there to begin with. Tenant balance column on the right, that shows what people owe. If you see that the people are not paying rent, which is a real problem through COVID, we really saw a lot of people stopping paying the rent. So if you see that people aren't paying the rent, I may not analyze that deal any further. One tip I look for, I'll tell everybody, I look at the move-in column on a rent roll. I look to see if I've taught Roberto all this stuff.
You've told me about this, the one that we went over.
Exactly. We just covered this. So look at the rent roll and look to see if a bunch of people just moved in recently. Like what I'm looking for is to see if maybe the seller moved in a whole bunch of people about 60, 90 days before they listed the property. So if I'm looking at that rent roll and I see a bunch of leasing activity, that concerns me that maybe that property really doesn't lease up very well. And then all of a sudden the seller just opened the door and flooded it with tenants right before they sold. So those are things that I look for to maybe try and kill the deal. Then I look at the profit and loss of the trailing 12, read that, just kind of run through there. Do I see anything crazy? I'm looking to make sure the numbers aren't going down. Like if you're looking at a profit and loss in a month-to-month format, we'll call it trailing 12, and you see the last 3 months, which we'll call a T3, you see that in decline, be careful. That's going to be a hard loan to get. So if I look and see the numbers are trending down, I may not analyze that deal any further. But that's what I'm looking for. Just kind of read that, see if there's anything crazy in there. And then I break out a calculator or deal analysis template, and I just try and figure out my debt service coverage ratio. That's the big one. That's the one thing everybody needs to pay attention to. Is just calculate, put in the purchase price, put in your income and expenses exactly the way the seller has it. No pro forma stuff. Calculate your mortgage and see what your debt service coverage ratio is. And if it's low, you're going to have trouble getting a loan. And that just makes you either have to put down a whole bunch of money or lower the price. And lowering the price is something kind of hard to do these days. So that's what I try to do. A quick analysis. I know that probably doesn't explain a whole lot, but that's sort of the answer.
So if people don't know what a debt cover ratio is, what would be considered a good one, and what is that exactly?
Yeah, debt service coverage ratio is the ratio between the net operating income and the payment to the bank. So for example, if we sit down and we look at how much money this property collects, and then we look at how much we're going to spend on the mortgage each month, and for every $1 that we have in our net operating income, we have an equal dollar of debt. That would be a debt service ratio of 1.0, meaning $1 in revenue to $1 in mortgage. We're break even. That's not good. So you lenders want to see you to be at a 1.2 to 1.25 debt service ratio. If you're talking about agency debt, Fannie and Freddie, 1.25 guaranteed. If you're at community bank, you might can pull it off at a 1.2 number. But it's basically you need to see about 20% revenue above the mortgage, or a lender is going to get uncomfortable with that loan. And so right there, if you calculate the deal and you see that the number is below 1.2, there's only two things you can do: borrow less or pay less. That's it. You can just borrow less money, put down more, put down more, put down more. Also, the debt ratio will come up, and then you're fine. Yeah, but if you got to go put a 40% down payment down, I mean, that probably kills your returns. All right, so that's one problem. You can also lower the price, and that will bring the debt service ratio up. But when you find out that you got to discount the property 20, 30, 40% to get the numbers to work, that's not likely to be something a seller will agree to. So those are just things you just got to watch.
Do that.
No, but that's when all of a sudden you start using creative financing. I hear there's a good book on that, actually. But
there you go.
I was just going to ask, there's been a debate I've been having with a few people and a few coaches when it comes to, we taught in Jake and Gino the value of a credibility book and kind of having a document where you're able to show what you're doing. I've also heard it on the other aspect be, hey, people who play well in the game don't show up saying, hi, I play well in the game with a document. What is your perspective on that?
You know what my opinion is, because I'm the one that gave you that opinion. I don't agree with the credibility book stuff. in that camp, and I know that technically as a company we teach credibility books and stuff like that. I have been very public, and I will continue to be public, saying I don't think that's a good idea. I think it's a very amateur thing to do. I don't think a real buyer shows up with a credibility book. They might show with a resume, maybe, and you're not even going to flash a resume until someone asks you for it. But, kind of showing up and shoving some form of credibility in everybody's face pretty much is an indication you probably don't have any credibility. And so, that's kind of the issue there. It's a feel-good item. It's something that you can teach a student when they're brand new to the business to go out and do, and they feel like they're getting traction and they feel like they're getting something accomplished, but they're not. It's just activity, and it's nonsense activity because it doesn't really get you anywhere. So you've created this credibility book. Okay, great. What did you put in there? If you're new to real estate where you need a credibility book, what the hell credibility is going in there? You haven't bought anything yet. Like, oh, I lived in some apartments once. I mean, is that really going to, come on. Education would be the only thing you could really put in your credibility book. So talk about it. Credibility comes when you can talk the talk, walk the walk, when you know how to analyze a deal, when you meet a realtor and they say, hey, Roberto, how did you come up with this number? And you go, well, actually, the cap rate and the debt service ratio because of the income. That's credibility. When you open your mouth and your education comes out, you don't need any further credibility than that. You don't need to go shoving resumes in people's face. If you can articulate what a good deal is and you can talk to realtors, you know how to analyze a deal, that's all you need. And then after that, just be honest about the fact that you're new to business. Everyone started somewhere once, right? And everybody gets a break. So the sin here would be if you're new to business, you don't have any credibility, and you sound like an idiot when someone wants to talk about real estate. Okay, now we got a problem. So don't sound like an idiot. You know what I mean? Go get an education, learn, and then be honest about your experience. You're fine. You don't need anything else. And fake it till you make it is very difficult in this business because it's super easy for a professional to spot someone faking it. So that's why I don't like this credibility book thing. I think that can probably put you off on the wrong foot very quickly. But thank you for asking that question so that I get to completely say that everything these guys are teaching. No, just kidding. That was a setup question. I knew that was coming.
I was just curious. It's something that we've been running into.
So what's the best way to build relationships with because you said most of the big deals come from brokers. Now, how do you build relationships with a broker also? Because they probably, I'm a real estate agent also for the residential. It's like I have everyone always come to me oh, use me as a lender and stuff like that and all that stuff. So how do you build a relationship where you're that person for?
Yeah, property tours, the short answer. You want to be doing property tours. Yep. The worst thing that you can do right now, and you'll probably appreciate this being a realtor, but basically the worst thing you can do is what I call the sit on Santa's knee routine. It's like I see so many students calling up realtors like this is Santa, and they're sitting on their knee telling them what they want for Christmas. Oh, I want a great deal with a lot of cash flow and a lot of equity and a pony and a bicycle. You're like, all right, look, come on, knock it off.
You want a unicorn.
Yeah, right. I mean, that's a waste of time. So calling up realtors with your wish list of what you think is a good deal isn't a good way to establish a relationship with a realtor, because if they don't have that asset for sale right now, then you're just asking them to remember your wish list, someday in the future. That's a waste of time, and basically, essentially what you're doing when you start reaching out to realtors that way with this sort of just call them up and tell them what you want for Christmas kind of idea, you're essentially asking that realtor what you're saying to that realtor is, hey, the next time you get a really good deal, ignore all of the clients that you've already been working with, ignore all the relationships you already have with all the buyers and all the people, ignore all of them and be sure and send that really hot deal to the guy that sent you an email one time and save the hot deal for the person. Give me a break. That's ludicrous. It's not going to happen. So you've got to build that relationship, and just calling these realtors up and saying, here's what I'd like to buy. Here's what a great deal looks like to me. That's a waste of time. Call realtors about a listing they already have. That's the key. So go to their website, go to their wherever they're putting out marketing website, MLS if you're looking at single family or LoopNet or wherever, and figure out a current listing that the realtor has today. Call them about that listing. Ask them questions about that listing, even if you don't like it, even if you don't want to buy it. That's the way to establish a relationship about something that they can talk about that they already have. Meet them on the property. So I would not start asking a whole lot of questions over the phone, trying to chit chat and ask questions, because it comes off wrong. Just go meet that realtor on the property, build your credibility and establish commonality with them on the property. The other big mistake that you can do is trying to get to know someone, a realtor, over the phone too quick. It's not a date. Don't try and turn it into a date. Don't call up the realtor and be like, oh, let's talk commonality. Hey, what kind of football team do you like? Where do your kids go to school? Man, this Monday morning, I'm trying to close some deals. Get out of my face with this nonsense. Not interested. That comes off weird. Take a realtor to lunch. No, don't go taking a realtor to lunch. These people can pay for their own lunch. They don't need you to pay for a lunch. Close a deal. That's what realtors are after. That's how you get relationships. But
get them paid.
Stuff doesn't work. Yeah. What's that?
I said, get them paid.
Yeah, exactly. Close a check. That's all they care about. Property tour is the easiest way to start getting traction with realtors, and just go meet them. Show them that you can show up. That'll put you ahead of a fair amount of the market if you just show up.
So just to channel back into the deal itself, when you were first starting out, what are some of the mistakes you made through a lot of the deals? I know, like you. So,
yeah. What kind of mistake do you want to know about?
Or even let's say someone first starting out, what's some of the mistakes that you would say, hey, this is a step I made. This is one of the you starting over from scratch. What would be the best
okay. I probably, to go back in time, that kind of thing, I would probably try and go larger sooner. There's a big difference between a house and 100 units, yes, but there's not that much difference between a house and 10 units, or 10 units and 30 units, or even 30 units and 100 units. It's just try and get going bigger if you can help it. You can only go as large as you can borrow and as large as you can fund. I understand that, but I would have probably started trying to network, build partnerships earlier on, get out of the house thing, get into multifamily a little bit quicker. It's economy of scale. That's the real answer. Is the faster you get to an economy of scale, the more you're going to be running a real business. And it's very difficult to run a real portfolio and make it a real business with single family. I'm not saying impossible. It's just a lot harder than it is with multifamily, because you have the economy of scale. So I would tell people, try and scale up as quickly as you can. But again, that's going to be a function of your borrowing power. And that's going to be a function of relationships. So work on those money relationships.
You were talking about borrowing power. Is there I know I've read your book a couple of times. It said you talked about you can only borrow based on how much net worth you have, or can you talk about that?
Yeah, for commercial loans, larger commercial loans in standard. And again, there's no laws, but standard, you need to have net worth equal to or greater than the loan amount. And that's something that people don't understand. So, or most of the time they misunderstand. So in single family lending, small multifamily, duplexes, quads, things like that, basically the lender is looking at your W-2 money to cover the mortgage if something happens, and they're looking for the property to appraise. If the property appraises and you have enough W-2 money, you'll qualify for the mortgage. In larger commercial, let's say this is 100 units, nobody's looking at your W-2 money to see if you make enough money to pay the mortgage on this 100-unit apartment complex. That's not how it works. They look at the property to see if the property creates enough revenue to qualify for the revenue portion of the loan. That is the debt service coverage ratio we discussed. All right. They look for the property to appraise. So there are those two aspects. Now they look at you to see if the warm bodies, the humans guaranteeing the loan, have net worth equal to or greater than the loan amount. And so that's where we can kind of have some mistakes sometimes when people say, oh, in multifamily, the property qualifies for the loan and you don't have to worry about that. That is not true. That is a misunderstanding. It's true-ish, but it's not true. Where they're misunderstanding that is, yes, the property's revenue is what is used to qualify for the loan, not yours. But they're leaving off the fact that you have to have net worth equal to or greater than the loan amount. So that's why I kind of say you need to sit down and figure out how much net worth you have. And that's about where you can start borrowing today. So if you want to go to properties that are larger than your borrowing amount today, you just need to bring on what we call sponsors, or individuals that would join you on that mortgage and bring net worth and experience. So that's kind of how you can accelerate your business, is by bringing on people that allow you to purchase larger and larger properties. And that's syndication.
Okay, so you're talking about networking before, and you just mentioned bringing on those key sponsors into your deal. You value your time very greatly, and a lot of other companies that are broadening to the institutional levels value their time. What would you say would get your interest and want to work with somebody who is brand new, more of a newbie aspect? How can we get someone's attention like that?
Find me a deal. Yeah, bring me a deal and I'm interested. That's that's not actually a sarcastic answer. I'm being dead serious. That's one of the biggest values that you can bring when you are brand new to the business, and you don't have a lot of money and you're wondering, okay, how could I get, a millionaire? How could I get someone with the experience to come over here and sponsor this loan? Well, the number one answer is back to education. Get your education in the business so that you know what you're doing now. Now it's just a function of exchanging your time for money. So you've got your education, you know what a good deal is. Now go out and find a good deal. Once you've found a good deal, it's a lot easier then to reach out to high net worth people and say, hey, I have something. Are you interested? That's kind of the model. Now you want to be establishing relationships with investors before you find a good deal. I'm not saying go find a deal and then meet people, probably a little late then, but that's the number one way that someone is new to the business can bring value to others that are in the business is deal analysis and sourcing deals. And that's free. It only costs you looking at deals online. It only costs you driving over and meeting the realtor. That's free. Finding deals is inexpensive. And that's how you bring value to people like myself and to other people that are in the business. But you got to know what a deal is. You can't call me up every afternoon and go, hey, well, how about this one? How about this one? How about this one? How about this one? I don't have time for that. But if you know what a good deal is and you bring me one, hey, that's different. So go get your education, source some deals, and call me.
What for a good dealer? What IRR are you actually looking for? Like for you personally, you say someone's around and they find a.
Yeah, I would say 15% IRR, kind of on the bottom side. It used to be around 20, but I think expectations have come down. You can show something that's for me personally. If anybody's listening, I'm looking at 100 plus, B class to A minus, core market. Cap rate above 4. Good luck. And debt service ratio at least to 1.2, and cash flow need 4%, 5% year one, something like that would be all right. With an IRR, projected IRR of 15 or more, that'd be okay. And to me, that's even just an okay deal. But that's what I would buy something like that in this market. So but I'm really not interested in old stuff. I'm older assets that concern me at the moment. Only at the moment due to the price. You can buy older assets at the right price, that's fine, but they're overpriced right now.
What's considered older for you?
60s, 70s construction.
Oh, okay.
Yeah, the infrastructure, a lot of those buildings is starting to get a bit old, and I am afraid that the pricing does not reflect the hidden costs that are inside some of these old buildings. And I've been an operator for 16 years now, so I know when you pop the hood on some of these buildings, I know what's in there, and that concerns me when you overpay for that and ignore the fact that your car has no brakes. It's not good. And some of these properties have no brakes when it comes down to like plumbing and infrastructure, and I'm just, somebody's going to jump track with one of those if they're not careful, but that's my opinion.
So what's your end goal? You mentioned before legacy. Is that what kind of like motivates and drives you? Like what's your purpose?
I don't have any kids. I don't care anything about legacy. I can't take it with me. Can't spend it. Not interested in it. No, I enjoy business. I like creativity. I like doing business. I like helping people, so I like to teach. But no, I just enjoy it. It's a business as good as anything else. It beats being a win and where told to fly airplanes, that's for sure. And it pays well. So no, I just enjoy it. I think everybody kind of thinks I'm going to have some kind of I want to leave $1 million to the grandkids and all this kind of stuff. Nah, I'm just bored. Don't have anything better to do. Don't like jobs. Enjoy real estate. Don't really have much of a better answer than that. Happen to be competent at it, so it's easy.
I gotcha.
Yeah.
Well, just trying to wrap it all up. Like, where can people find more about you? Find your books on Amazon?
Yeah. Creative Cash, Real Estate Raw. Those are the books. They're on Amazon. I have a website, realestateraw.com. If you want some free videos on how to get started, and I have some other educational material, check me out at realestateraw.com. And yeah, I'll give you my email if anybody wants to email me. It's Bill, BILL at gobroadwell.com. Broadwell, BROADWELL. So it's just Bill at gobroadwell.com. Yeah, likes, comments, concerns, let me know. Love to hear about it.
Find him a deal. Save him some time.
Buy me a deal. I'm buying. Yeah.
If you're going to email him with a deal.
Send me some deals. Make sure it's a good deal before you send it to me.
But
Yeah,
hey,
excellent.
by the way, I appreciate you coming on here, and I know I've learned
thanks
a lot.
for having
Always learn a lot talking to Bill.
Yeah.